Hello and good afternoon. Welcome to our webinar focused on understanding key investment metrics and why they matter. Thank you for joining us today. We hope that you find this webinar insightful and continue to join our 8-part webinar series on effective investment oversight. Before we begin, I'd like to note that all attendees are on mute, but should you have questions, you can submit them in the control panel under the questions field. Only the presenters will be able to see your question. So let's get started. I'm pleased to introduce Senior Consultant Bill Karsten and Senior Investment Analyst Tom Loftus. Gentlemen.
Hello, and thank you for joining us. This is Bill Karsten, and Tom Loftus will be weighing in a little bit later. At first, just want to note that we do record these webinars and we make them available on our website. This is part 2 in our 8-part series focused on investments. So if you did miss the first part, you can go to our website and get a replay of that webinar. Also, just want to note that our webinars are focused on institutional retirement plan investments. So everything that Tom and I speak to today is along those lines of really being focused on those institutional retirement plan investments and proper oversight approach. So with that said, let's get into the webinar. And so let's start with, what is our starting point? And I don't know if others are big in acronyms, but discovered, with the 3 topics we really are looking to cover here, I would say are define, identify, and then perspective. And so DIP is our acronym here, but just to reiterate, the focus should be to first define each investment and its objective. And then once you've done that, it's important to identify key metrics for each investment, and after that to then add perspective. So, taking that a little further, it's important to first define what type of fund are you analyzing, and then 2, once that's been accomplished, properly determine and align the key metrics that are to be emphasized. And then probably most critical is to add the proper perspective to your fund analysis. So, we'd say, going back to the top of the page here, the sub-bullet, different investments have distinct objectives, and measuring their success should be tailored accordingly. So for example, whether you're looking at a bond fund or an equity or stock fund or a real estate investment, certainly is going to weigh in heavily in terms of how you define that each investment and identify those key metrics as well as determining the proper perspective. The next point, emphasis on downside protection, long-term results as well. Again, we're looking at retirement plan investments, so we're looking to get the best outcomes for participants who are, most of them, hopefully investing for several decades. And then on the next point, actively manage investments. We're seeking to produce better results. Well, what does that mean? From an obvious standpoint, we'd like to see better net returns, but also risk measures are critical. So, for example, if you have a fund that provides similar returns but is able to do that with lower volatility and while also providing better downside protection, we definitely see that is equating to adding value. So what are some of the key investment metrics? Again, as we're looking at actively managed investments, we identify here just some of those core measurements that would serve as that starting point. And then the next step would be to take a deeper dive into performance and risk measures. And again, that's going to vary from fund to fund. And then after going into that deeper analysis, it's important to assess the qualitative factors that are key. And for example, management team and the overall investment strategy of the fund and so forth. Again, we talk a lot about the quantitative, which are the measurements, some of which we identify on the page here, but certainly those qualitative factors are key, and Tom's going to speak to that quite a bit. And then for passively managed investments, The objectives are simple. What benchmark are you tracking? How closely is the investment tracking its designated benchmark? And then, of course, cost is a key factor. Why would you pay more than you have to for an investment manager who's simply trying to track an index? So with that background, I'm going to turn it over to Tom, and he's going to go a little bit more in depth and provide us with some examples.
Thanks, Bill. And with that context in mind, the next slide we have up on the screen here is defining your benchmarks and your peer groups. So Bill spent a few minutes helping with an overview of defining the characteristics of the investments themselves. And with that information, designated what investment metrics to focus on in assessing those investments. But, and as the first bullet point on the slide here points out, without having the proper context, there's not much that raw investment data can tell you. You need a standard to hold the investments to. A great example that I like to use that's somewhat applicable, if you go in at the end of the year to review your personal portfolio with your financial advisor, and they tell you it was a great year, we got 11% return on your portfolio, historical average was 6%, we nearly doubled that. Fantastic, that sounds great. I would challenge you on the receiving end of that statement from your financial advisor to ask, well, how'd the market do? And if it was 2019, the market returned 30%. There were even some bond categories that were returning 10 or 11%. So once you add that perspective, your 11% return pitched by the advisor doesn't sound nearly as impressive. In a similar vein, when you're identifying and assessing an investment, you want to be sure that you have something to benchmark that product to. And equally as dangerous is not having a benchmark or a peer group at all to make comparisons to, can be having the wrong benchmark or the wrong peer group, as that first sub-bullet point on the page states. And this is something that we run into all the time on our end when we're looking at investments. And it's a good point to pause, and a piece of advice that I'd like to add to the mix now, which I'll bring up again here in a few slides, is as you're analyzing investments, always have a professionally skeptical mind. If something looks like it's too good to be true, there's a good chance that it is. And how that ties into this example, you may be looking at an investment and you look at 20 different charts and it's right at the top of all of them. This is the surefire best-in-class performer. You do a little bit more digging and you realize that, well, it looks so great because it's an equity fund that I'm comparing to a bond benchmark. So a very simple example, but the point holds true. Both having benchmarks and peer groups, as well as having a thoughtful approach to identifying those benchmarks and peer groups is key. So a next question likely in mind is, where do you find and how do you define those benchmarks and peer groups? And what we encourage plan sponsors to do is first, start at the most logical source, the provider of the investment itself. Every investment that you might be analyzing is going to have a web page on the investment manager's website, and within that page, there are going to be good, hard definitions of that fund's investment strategy or that investment's benchmark, the style of investment. This is the best starting place to home in on what your benchmark should be. It also gives insight into how exactly that investment strategy invests, which should help you better shape what kind of peer group you would like to use to benchmark that investment. The second sub-bullet point at the bottom of the page, using third-party outlets to identify benchmarks and peer groups. We would strongly encourage plan sponsors to supplement whatever they do find on an investment manager's website with what's available publicly via third-party outlets. Morningstar is a great example. They're a leader in investment research and data aggregation. Anything and everything fund-related and data-related will be aggregated on Morningstar's website, and Morningstar applies its own subjective assessment of what the correct benchmark and what the correct peer groups for an investment might be. So the next slide, just a quick snapshot of what you'll see when you land on the Morningstar homepage and search for an investment. You can see on the page here some good basic information about the fund itself that we have here, the Vanguard 500 Index. You can see on the bottom left side of this snapshot that Morningstar right up front identifies the category and the investment style of the fund, providing quick, clear indication of the peer group that this fund falls into. Similarly, if you were to move across those top tabs and look at the performance of the Vanguard 500 fund on Morningstar's website, what you would quickly see is a summarization of the benchmark that Vanguard itself is using for this fund, as well as the benchmark that Morningstar sees to be the best fit based on the characteristics of the investment. I'll also use this opportunity to plug in some additional value that Morningstar offers. So a few slides back, Bill was speaking to some of the basic investment criteria that you may be using to assess an investment. Raw performance, a standard deviation, something that's risk adjusted like a Sharpe ratio metric. Well, if you don't have an expensive subscription to an investment analysis platform, you can't go in and run those calculations, and you certainly don't want to open an Excel spreadsheet and do those calculations yourself. That's why we'd recommend Morningstar. They've got the data, they do those calculations for you. There's a wealth of information about any type of investment that you might be assessing on Morningstar's website, including some of those key metrics to help get you started in investment analysis. So the last piece of our acronym, the perspective, adding perspective. At this point, we've identified the type of investment that we are analyzing and the objective of that investment. We've connected that insight to key investment metrics that we would like to use to assess whether or not that investment is achieving its objective. And we've also added the context of benchmarks and peer groups to help pull some value from that raw data. So where we're adding in perspective here on the slide is taking all of that information together and subjectively identifying how we want to look at things like performance, how we want to look at things like risk, and how that aligns with the actual investment objective of the manager to be sure that we are correctly assessing the value of that product. And I'll bring up the same point here that I've already brought up, that professional skepticism. Again, I don't think there's any clear indication that investment managers are maliciously trying to hide any key information from you when you're analyzing their investments. But what I do know and what I can share is some valuable information may be inherently hidden. And if you're limiting yourself to, taking an example from the page here, just a single point in time measurement of, say, a standard deviation as of the end of last month, you're not getting the whole picture. And, tying all of this back to institutionally focused investments that we commonly see in retirement plans that have a very long-term approach to investing. Limiting yourself to looking at performance or risk or the like over the past 1, 3, even 5 years, it may not be telling the total picture. So the key on this page is really putting some thought into identifying how you want to apply performance and risk criteria to give yourself the strongest indication of how an investment is performing relative to its objectives. The next page brings all of this together, and it uses an example. What we're looking at on the slide is an actual fund that Plan Pilot has vetted, and it's a fund that we implement in many of our clients' plans. And what we have here are two charts that we certainly look at on an ongoing basis related to this fund and others, as well as during our original assessment of any investment product, including this one. And so at this point, let's say hypothetically with this fund, we know its objective. We've gone in and we've identified how it invests and applied a benchmark and a peer group to it. and we know which metrics we would like to focus on to be sure that we are correctly assessing whether or not it's achieving its objective. The two charts that we have on the page, same exact template, and we're looking at the same metric, performance. But on the left, we're looking at rolling performance on a 1-year basis, and on the right side of the screen, we're looking at rolling performance on a 10-year basis. And the question that I've posed at the top of this slide is, would you as the viewer of these two charts make the same decision to buy or sell this investment based on both of the charts on the page? And if you're answering no, we would completely agree. If I were looking at these two charts in isolation, what I see is on the left a fund that's up and down, ahead of, behind its benchmark from time to time. But what I see on the right is a fund that is consistently outperforming its benchmark and is performing well over a longer term time horizon. So, one, this example stresses the importance of putting together all of the pieces of the puzzle to create a very holistic oversight approach and evaluation of different key investment metrics. And it's ensuring, again, I stress this point, aligning your assessment of key investment metrics with the actual fund objectives. The second question we pose at the bottom of this slide, which of these charts should carry more weight in the investment decision? We'd easily argue that chart on the right side that measures 10-year rolling performance. We know that this is an institutionally focused investment that invests with a very long time horizon. And in the context of a retirement plan, you want to take a step back from the day-to-day results to focus on how an investment is going to serve plan participants over the course of decades of retirement savings. We feel the chart on the right side of the page does a much better job of assessing that. We like the way, certainly, that this fund presents its long-term performance. It's not to say we would ignore the chart on the left, but it's an appropriation of weighting in our investment evaluation to the metrics and the time horizons that best align with the investment objective itself. The last question, the open-ended question at the bottom of the page, what about risk? I don't have the answer to this question, but it just provides, again, a re-emphasis on the value of having the entire picture. We've looked at two charts. We've theoretically made a decision on this fund based on both of those charts, but at no point on this slide have we looked at anything risk related to this fund. So, I don't want to oversimplify and say that this is the investment analysis process. There's a lot more that goes into it. There's a marrying of different investment criteria to come up with a broader assessment of an investment's value. And that's where that question about risk comes in at the end of the slide. The next slide up on the screen here, applying past performance to future results. So what I have on the screen are snippets that we took from 3 reputable asset managers' websites. And if the font is too small to read, no fear, there's really nothing too different being said across these 3 asset managers. The statements, in essence, say, past performance is no indication of future results. And you will see this disclaimer posted on any website, on any disclosure, on any statement that involves any investment information. And it begs the question, what the heck have Bill and Tom been talking to us about for the past 20 minutes? And what is the purpose of using historical results to gauge the performance of investments? And it's a very valid question. And of course, because our presentation is focused on key investment metrics, I think we have a very good answer for it. But before I speak to that answer, I do want to stress a very important point here. Relying too heavily or relying exclusively on the performance history of an investment to make investment decisions can be a very, very costly issue, and it is an issue that plagues the industry that we all work in. When you over-rely on past performance, you end up doing the exact opposite of what prudent investing dictates. You buy high and you sell low. And compounded over long-term periods of time, that type of behavior can have serious implications on your plan participants' retirement outcomes. So that said, what I will stress is past performance should not be the sole guidance for decisions about future results, but using past performance to evaluate investments is a great tool, and it is one of many tools that needs consideration. So a few of the examples that we use here to supplement past performance: a more subjective and qualitative analysis of an investment strategy, an evaluation of the people that actually manage and run that investment, an understanding of the resources and the core competencies that the asset manager sponsoring the investment has to offer. Once you have a better understanding of these supplemental pieces of information, you can drive much more value from the historical performance results, and ultimately then you as the plan sponsor can draw your own conclusions about whether future results can match past performance. But relying on past performance alone, it's not going to do it. A few easy examples that we've run into: maybe a manager becomes too large. They've had a very successful few decades of managing money. Investors are attracted to that. Assets continue to flow into the investment. Well, as that investment grows, the investment manager is tasked with putting that money to work. And eventually a fund can become so large that it can't put money to work in the way that it successfully had previously. And so you can see performance deteriorate because that manager is now restricted by the pool of assets at its discretion. Similarly, you can have an investment that's performed exceptionally well for decades, but at the beginning of the year, the portfolio manager that made all of those good decisions retired from the firm and left behind two young analysts to take over leadership. At that point, it's very difficult to drive much value at all from the historical performance results of that fund. And the last, an underappreciated example, but one that is honestly very prevalent, is luck. With stocks, you're betting on one of two things: that the price of the investment is going to appreciate, or the value is going to go down. And there are investments out there that have done exceptionally well, and whether or not the managers are willing to admit it, they happen to be in the right place at the right time, or made a few very good calls that have been very fruitful for the long-term performance of that investment. But if the strategy is not disciplined and thoughtful, there's not much value that you can extrapolate there. There's really no clear indication, unless that manager gets lucky again, that they can continue to operate with that same historical performance success that they'd already realized. So with that, I'll turn it back to Bill to summarize.
Thanks, Tom. And just a side note for what Tom was talking about, the luck factor. It reminds me of a fund I'm familiar with, which is a very interesting case where I would call it luck that this management team had a very good year in the late 90s, and they were winning clients because they were touting their 5-year returns, and then they were touting their 10-year returns, and then it became 15-year returns. And what's interesting is when you dig into it, all the performance happened in 1 year. And so, going back to that chart that Tom was showing, we look at rolling returns, because if you just look at an aggregate, and managers could be tricking you by just showing that one great year they had years ago, and they're underperforming ever since, but that 1 year is carrying them. So, in terms of the metrics that you analyze, that obviously is always key. So going back, just a summary, again, as we noted before, define each investment's objective. That's really critical to going into the next steps. And at Plan Pilot, we always talk a lot about both the qualitative and the quantitative. And I flip those around. Let me flip it back and say the quantitative and then the qualitative. So, identifying key metrics and analyzing the data, it can only take you so far. The quantitative needs to be married up with the qualitative, and that's where you're adding the perspective and going into greater detail to learn more about the management team and their management strategy and so forth, to ensure that you're identifying truly successful managers versus those who may just be coming off of a lucky streak. So, just going through some of the summary points here. Again, we've talked about performance, we've talked about risk, and we've talked a lot about the qualitative measures. In future webinars, we will discuss investment selection and monitoring strategies and do a deeper dive on that. And we'll go further into investment metrics and qualitative factors in future discussions. And then I just want to add one last item to that final bullet point there, identifying and addressing potential problems. We should add some more words there to say before they show up in a fund's performance. And again, any good analyst team, that's really what they're trying to do. They're trying to marry up the performance numbers with those qualitative factors that we can get our hands around with the management team to try to identify if a problem might be coming and try to avoid that before we see it in the net returns. So thank you again for joining us. Hopefully you'll join us again for future webinar sessions. And as we mentioned, we'll be incorporating some real life examples and case studies, which we think that you will certainly find to be of interest. So thank you again and enjoy the rest of your day.